Should a church invest their money? This is a question that I was originally inspired to do a whole episode on from a post inside a private pastor's Facebook community group that somehow I got added to. And this was 4 years ago. I didn't realize how long it had been until I searched it in preparation for this episode, and I saw it was 4 years ago, so I guess I'm just finally getting around to doing this. But it's a really interesting question, and what I noticed is there were some people who were very much in favor and some who were very much opposed. And I know it's shocking that pastors would vehemently disagree about anything church-related. I know, so very, very surprising. But it's a very interesting question. I think one that deserves a very well thought out answer. That's what I'm going to attempt to do in this episode. I'll say this at the outset. I think many of us are reluctant about this idea of a church and investing funds because it seems to be a weird mismatch. I feel this personally. It feels like investing is profit and risk in the market, and church should be about generosity and sacrifice and the gospel. It's like they don't go together. It's like mint chocolate chip. Yes, I said it. Mint chocolate chip is disgusting. Don't put those two things together. But let me try to make the case as best as I can for both directions. I'll try to argue why churches should not invest their money. I'm going to try to argue why they should. And at the end, I'm going to give my own personal thoughts and practical considerations, maybe a couple options that many people are not aware of. So let me just start by addressing some of the most common objections to a church investing its funds. I'm sure these aren't all the reasons. If you have other reasons you'd like to let me know about, I'd be happy to hear those. info@nateskelly.com is my email for all comments, constructive or otherwise. Okay, number one, it distracts from the church's mission. And the church's mission is to spread the gospel. We're not to accumulate wealth or act as a financial institution. So by investing funds, it distracts from what the church should be about. And we see this in Matthew chapter 6. Jesus was very clear, do not lay up treasure on earth, lay up treasure in heaven. In Acts chapter 2, we look at the early church, and what were they doing? They were pooling their resources together and giving it. They were helping those in need instead of stockpiling their wealth. So the idea that a church would invest its funds necessitates that those monies are not being used right now. And it would seem unjust that there are so many immediate needs in our world that could be met, but a church would be choosing to stockpile their wealth instead of distributing and helping those in need. And this might be even more acutely felt by other Christians, other ministries, places where they desperately need funding for their missions work, for church planting, for foster care, for homelessness. And they would see other ministries that have the capacity that could help out, but are choosing to invest their funds instead. Secondly, there is a risk of financial management or corruption. 1 Timothy chapter 6 tells us that the love of money is the root of all evil, and certainly churches and people in churches are not immune from that. Luke chapter 16, Jesus talks about the person who is faithful with a little will be faithful with much, but the person who is dishonest with a little will be dishonest with much. Putting money into investments brings up the possibility that the person handling or making those investment decisions might not act with integrity. There's some more recent examples. If you remember Robert Schuller, Crystal Cathedral, they had a bankruptcy back in 2010, due in part to mismanaged funds and poor real estate investments. I've seen this personally in my own life. Back in the early 2000s, probably about 20 plus years ago now, there was a guy that he traveled to lots of different churches and kind of presented himself as a Christian financial guru and would teach about finances, but he was running an investment opportunity, as it seemed at the time, but it was really just a Ponzi scheme where people would invest in mobile billboard advertising. But really what was happening is any money that investors were getting on their returns was being paid out with new money that was coming in, and he eventually was caught and sent to jail for a long period of time, as he should. But what was really tragic is that we knew several people personally that lost money with him. There may have even been some churches that invested church funds and lost their money in this way. So there's definitely always that risk that you're inviting that possibility that depending on how or who is doing this investment, there could be mismanagement or corruption. Thirdly, the church is a nonprofit. So investing would go against that status as a nonprofit. Let me just clear up a little bit of misunderstanding here. In technicality, this is not true, but maybe in spirit, it could be true. There's generally a misunderstanding about what it means to be nonprofit. That does not mean that the entity can have no profit. That's not what that means. It means that the primary purpose of the entity must remain for religious, for charitable, for education purposes, not for financial gain. So there are nonprofit, quote-unquote, entities who try to game the system and give all churches and nonprofits a bad name. But a church that invests funds for future ministry use is not what we're talking about here. Like, I mean, for instance, the Mormon Church has an estimated $100 billion that it manages, and it still retains its nonprofit status. Not that I'm encouraging you to mimic the Mormon Church. But for example, like hospitals, universities, large nonprofits, a lot of them have investment accounts that they use, and they take the returns, the interest, dividends, and they use that to sustain their operations for the long term. That's not an issue. That doesn't put their nonprofit status in jeopardy. So a church that would have interest or dividends or capital gains from an investment account doesn't mean all of a sudden their nonprofit status is now in jeopardy. So on a technical basis, this is not a concern, but maybe more in the spirit of what this argument is getting at is, hey, the church is supposed to be a nonprofit, so let's behave in such a way that we're not prioritizing profit over the mission. And I can certainly understand that. By the way, interest, dividends, capital gains from investments from a church are generally not taxable to the church. If the church starts a business or does things unrelated to its mission, then it could be taxable. So for instance, if the church opened a coffee shop, but it was available to the public during the week, maybe that profit could be taxable in that scenario. Just FYI. Number 4, it can turn the church's dependence to man-made systems instead of God's provision. I think this is another important point to consider. Investing church money would mean relying on financial systems, the stock market, the banking system, these types of things, could lead to relying on those things rather than trusting on God to provide. In Matthew chapter 6, Jesus says very clearly, you cannot serve God and money. You can't straddle that fence. And by investing money that could cause us to start putting our faith and our trust and our confidence in money rather than God. There's a very interesting passage in Exodus chapter 16 where the Israelites, God miraculously gives them manna every morning to sustain them. But what some of the Israelites do is they try to save the manna. They try to store it. But what does it do? It rots by the next day. And what was God doing in all of that? He was teaching them to trust his daily provision. And I think there's a principle in that we should take to heart today. There's a real danger that if a significant portion of a church's resources or their income is reliant on their investments rather than just the regular giving of the church body, then they might drift in their reliance from God to self-reliance because, hey, we don't need God. We don't need to trust him. We don't need his provision. We're already set. And there are churches, there are denominations with plenty of financial resources, but their membership and their effectiveness is diminishing with each passing year. So it's better to have a healthy, growing church with limited resources than a stockpile of wealth and a dying church. Number 5, it is a betrayal of your givers to not use their funds for the intended purpose. Another objection would be that people gave sacrificially so that their money could be used for gospel purposes. If you invest that money instead, you've betrayed the purpose of those gifts. Now, the counterpoint could be we are using those funds for gospel purposes. We're just choosing to use it later rather than sooner. Maybe the way I've thought of it this way is it's almost like somebody gives you a gift for Christmas and you could choose to keep that gift and use it, or you could go to the store and return it and use that store credit, exchange it for something else, a different size, different color, or just get something else entirely. Now, some people would say, I wouldn't do that because I would feel icky about that. The reason they gave me a gift is because that's what they wanted me to have. But others would say, no, the purpose, the spirit behind the gift is they wanted to give me something that I will use and appreciate, so they wouldn't mind. This is an appropriate use of the gift that they gave me. So I'm sure that analogy breaks down to some extent, but that's kind of how I thought about it. Number 6, missional drift could cause the money to be used for different purposes. So the objection here is that if we're talking about a very long-term investment, kind of like an endowment fund, that means it really is impossible to know or to predict how that money could be used in the long run, 50 years from now, 100 years from now. And over time, ministries will change, both in terms of their practical efforts, even physical location, but even sometimes in their theological beliefs and teachings. So this kind of goes back to this idea of you could inevitably be setting up a church to have artificial life. They would be otherwise dying. Their membership and effectiveness is in decline, but because they now have these financial resources, they're able to persist, and they look very different than the type of church and organization that you originally donated to. And then last objection is kind of like a half objection. I'll include it as like 6.5. Investing could mean that the church is owning and or profiting off of companies that they would have moral issues with. So let's say by owning a mutual fund, maybe there's 100 to 200 companies in a particular mutual fund, and maybe 3 or 4 of them are involved in things that the church would not support. Maybe it's the production, distribution of alcohol or tobacco or abortion pills or fill in the blank with whatever the church might find objectionable. This is a little bit more of a partial objection. The objection here is not the church shouldn't invest. It's more of saying, if we do invest, there's a chance that it will go to something bad. So therefore, we shouldn't do that. So keep in mind, there are many different types of investments. The church does. We're not talking specifically or exclusively about stocks. So that's not the only way to invest. And also, there are other options that will help screen out stocks that might be objectionable. We'll talk about that here in a few minutes. So there are what I believe to be some of the strongest arguments against. If you've got more, let me know. But I think it's important to raise those objections. Now, let's flip the script. Let's go over to the other side, and let's make the case in favor of investing church funds. Starting with number one, the principle of stewardship encourages wise management. Definitely the Bible teaches wise stewardship, management of God's resources. That includes planning for the future. That means we use our time, we use our abilities, but we even use our finances well. I mean, the classic passage would be Matthew chapter 25, the parable of the talents. The servant who invested and grew their master's money, they were praised. But the one who buried the money and chose to not utilize it and not maximize its effectiveness, he was the one who was condemned. Proverbs chapter 6, well, all throughout the book of Proverbs, we see this principle of preparing for the future, saving, and planning. That's commended. Now, these are commands that are more to be considered on an individual level. Obviously, the parable of the talents was not written directly to a church, and Proverbs was not written with the church specifically in mind. But these are principles that would be wise for us to consider, that investing, really, properly understood, should not be about greed, but rather about faithful management of what God has entrusted. So a church that has a proper view and understanding of investing is not investing to try to maximize profit, but rather because they're trying to be a good steward, a good manager of the resources that God's entrusted them with. Number two, investing helps churches prepare for the future. The argument here would be that churches have long-term responsibilities, just like all of us. Just like we have retirement or maybe kids' education in the future or long-term care, churches also have some long-term responsibilities beyond just their immediate needs. Could be maintaining their facility, repairs, a new facility, missions projects, hiring staff in the future. And investing can help to sustain those ministries and those needs rather than solely relying on the monthly donations. And so we see this example in the Bible about planning for the future and setting aside money for future use. Genesis chapter 41 and Joseph laying out the plan for Pharaoh and the upcoming famine, setting aside 20% during those plentiful years so that during the years of famine they would be taken care of. Proverbs 21, another classic verse on this, that the wise person stores up treasure and oil, but the foolish person spends everything that they get. So many churches and denominations have established like endowment funds to ensure that even through economic hardship, whatever the future might hold, they can still continue to support those critical missions, benevolence ministries, and that they are prepared for those lean times, if you will. Number three, investing can reduce financial pressure on the congregation. So if a church has wisely invested their funds, that could reduce the need for, let's say, fundraising, constant fundraising, allowing members to give joyfully rather than out of obligation. After all, from 2 Corinthians chapter 9, we know that everyone needs to give as they've decided in their heart, not grudgingly, not under compulsion. God loves a cheerful giver. So certainly our giving should be motivated by love. Our giving should be motivated by a want to rather than a have to. Sometimes churches do their members a disservice by constantly putting pressure on them to say, hey, we need to make budget next month. Hey, we need to pay off the debt. Hey, we have this unexpected expense coming up. And when you're constantly bringing those needs up to the church and constantly asking people to give over and above the level of generosity that they're already showing, that can really weigh on a church. So some churches, maybe they invest in rental properties or lower risk funds, but they will be able to use that income or use those reserves to take care of those needs as they come up instead of asking for more giving on a constant basis. So instead of needing to do a capital campaign every 3 years or 5 years, the need for those special fundraising efforts could be greatly reduced. So the idea here is that a financially stable church would actually free up their congregation to focus on ministry rather than the constant fundraising. Number four, investing can provide for future generations. I think it's important for churches to think about their long-term impact, not just their immediate impact, and if at all possible, leave resources for future ministry work. Just like in Proverbs chapter 13, verse 22, a good man leaves an inheritance to his children's children. Churches can in a way do the same for future believers. But by the way, again, I'm not saying that these verses are written specifically for churches and that was the point of the verse. I'm just saying that the idea could be the same and the principle could be the same, that in the same way that we want to equip today's believers, if we can set up our future generations for success, we can be helping people both now and in the future. And there are many churches in America and Europe, they are still able to function today because of wise financial planning by past generations. I know that the flip side to that argument would be, well, kind of like we talked about before, investing could preserve a church for many generations, but depending on the church, maybe that's a good thing, maybe that's a bad thing, right? So investing ensures that the church can serve not just people today, but future generations as well. Number 5, investing can multiply the church's ministry impact. I think this is one of the strongest arguments in favor. If the church manages money well, they can actually do more good. We can support more missions. We can help more. We can help more people. We can expand ministries. In 2 Corinthians chapter 8, Paul said he wanted the Corinthian church to continue to abound, to excel in the same grace, and that was the ability to give more. Just like the Corinthian church had already given money, Paul said, I want you to increase. I want you to excel in your ability to give even more. So perhaps a way that a church might be looking at this is, hey, do we want to deploy $1 million today? Or would we rather try to deploy $2 million over the next 7 or 8 years? So the takeaway here can be that investing is a potential way to increase the church's capacity for generosity, not stifle it. And then 6th argument in favor of the church investing their money, investing could help the church avoid debt. This is closely related to the previous point about reducing financial pressure on congregations. Taking on debt means an increased expense to your church. It's an added pressure on top of that. So would it be wise stewardship to continually deploy the church budget every year and spend all of your reserves only to then have to take on a sizable mortgage later on down the road when you need a new facility or you need significant repairs? Or would investing reserve or excess funds set your church up to be able to pay for future needs in cash, or at least avoid having to take out nearly as big of a debt? If maybe you can't pay fully in cash, but you can significantly reduce the amount that you need to go into debt for. As Proverbs 22 verse 7 says, the borrower is slave to the lender, and anytime we can avoid being in a position of debt, that's always a good thing. Now, those are some really good arguments for, some arguments against. I'm sure there's people that can make those arguments much more eloquently and passionately than I can, but how do I, as a financial planner and somebody who's in the position of advising not only my home church, but also churches around the country about how to think about this issue, what would I say? Well, let me start with this. Number 1, essentially every church already invests their money. I think the really key thing to keep in mind here is you say, well, Nate, should my church invest their money? Well, the answer to that is you probably already are. If your church has a savings, a money market, a certificate of deposit, then they are investing those funds. They're placing them in an account that's designed to generate them a return instead of deploying that money immediately. That is investing. That's the definition of investing. It's just a very conservative way of investing. And there's very good reasons to do this. I think churches should do this. I'm not against this. Emergency funds, building funds, money designated for future use. I would highly encourage every church, if at all possible, to do those things. But the real issue here that people have is not with investing. So when people say, no, a church should never invest money, I know what they mean by that, but technically we're not talking about the same thing. So what they're talking about is the appropriate level of risk. That's what they're disagreeing with. Many people associate investing with risk. In their minds, they're thinking investing equals stock picking, stock trading, almost like gambling, it's stock market crash. That's what's in their mind. And so when they say, should the church invest? They're like, well, no, we shouldn't do that. We shouldn't be flippant or reckless with the money that people have sacrificially given for God's work. And if that's what you mean, then that's a point that we can all agree on. Certainly a church should not be flippant or reckless with money. We should not be doing something that's akin to gambling. That's a point we're all agreed on. So when we invest in a money market or a CD, we are taking a risk, just a very small risk. The bank could collapse. You would have FDIC insurance, but if there's still a risk, I mean, if you have money over the FDIC limit, or if there's a banking collapse that's so large that even the FDIC could not make everyone whole, there's still a risk. It's just a small risk. So every church invests. Not every church has the same risk tolerance. Not every church has the same financial situation, the same needs, the same facilities, same staff size, same congregation, same budget, et cetera, et cetera. So what I would really encourage you to do is stop thinking in terms of, should my church invest? but rather what is the appropriate way for my church to invest its funds? Because we are all investing to some degree. Number two, think very carefully about your church's philosophy of investing. So if you're trying to weigh what this looks like for your church, here are some questions that I'd invite you to consider. Why is your church investing for the future? That's any money that you do not currently have an assigned plan for. Any of those excess or reserves, you are investing them. Why? What is it for? What is the purpose? Okay, think very deeply and try to get a very clear answer on that. Another question to ask yourself is, do I believe it is wiser? That's the key word here. Wiser to use this money now or in the future. Make a list of current potential uses. If we were to use this money today, what would we do? Here's the list. And then what could we do with this money in the future at X modest return per year? And what would that look like? But most importantly, make sure to ask God for wisdom to define what good stewardship looks like for your church. And you will come to different conclusions. It's inevitable. Good people will disagree on this issue, but what's key is that we are trying to be wise and we are trying to be good managers of God's resources. So you may be in a ministry that has a million needs right now, and you are struggling to keep up with them all. The staff is underpaid, the people are ready to be mobilized, they want to serve, but the service opportunities are limited because we have budgeting constraints, and you have pressing needs. We need to improve the facility. We're not able to fund missions work to the extent that we want. And maybe all of these things would point you to the conclusion that any excess church funds, we need to deploy them now. There are needs on the table, and yes, maybe we keep a modest amount in savings, but that's about it. But maybe your church budget is healthy. Maybe staff are well compensated. Maybe the facility is in good shape. Members are very generous. They support missions work. They support church planning. And every year the giving has been well in excess of the needs. So the only problem you're really facing right now, it seems to be more of a growth problem. That the current trajectory, the facility is not going to accommodate them at the rate that we're going. So these might point you to the conclusion that your church needs to start setting some funds aside for a longer term goal of a new facility in a few years. And in this way, you'll be able to significantly reduce the debt that you would have taken on, and also the amount that you need to raise from a capital campaign, that the people won't be nearly as strained in that regard. So the question then becomes, all right, since we can come to different conclusions as to what the best use of that money would be now or later, what are practical ways to actually invest the church funds? Like, what would be talking about in addition to just like a savings account here? All right, so let's talk about some practical considerations. First of all, risk level is extremely important. I would never ever recommend investing church funds in the same way that you would invest personal funds for retirement. I remember some years ago, we had a guy come through our church, and I'm not going to say his name. I'm not trying to throw him under the bus, but it just becomes more shocking to me as time goes on. He was in a position where he gives a lot of like financial advice he does like financial reviews for church to kind of look over their books and give them recommendations on things that they might be able to do better. But he was telling us, our small group on a Wednesday night, that some years before, right after like the great financial crisis, kind of like 2009, 2010-ish range, there was a church that had some reserve funds and said, hey, what would you recommend we do with this? And he recommended that they put their money in Ford stock and in some defense sector stocks that ended up really taking off and doing very, very well. And at the time I thought, oh, that's kind of interesting. The guy wasn't even in finance back then. I was a teacher. The longer I get from that, the more I'm like, what? I would never ever recommend a church do something like this. That is way too risky. Church funds and the risk level that you would take with them is very different than an individual. Very different than how I would invest my funds personally, or how I would recommend somebody who's investing for retirement invest their funds. I'm not saying it's never appropriate for a church to invest some of their money in a well-diversified basket of stocks, but the type of recommendations I would make for a church, again, far more conservative than I would give someone who is saving for their own retirement. So risk level is extremely important in this conversation. Secondly, there needs to be a well-constructed investment policy statement. You say, what is that? Basically, it's a mission statement for those funds, for those excess funds. Here's what we will invest in, and here's what we will not invest in. Okay, we will invest in CDs or bonds or mutual funds. We will not invest in individual stocks or private real estate holdings or whatever the case may be. This would include, in the investment policy statement, the goals for the fund. Okay, what is this for? Like, what is the objective here? Do we have any specific requirements on how the investments are to be managed? the percentage range for different types of holdings. Okay, no more than 30% of our account can be in stocks, or we need to have at least this dollar amount in money market funds, or however that looks. And this is important because you just don't want to be making it up as you go. By having an investment policy statement, you are putting hard lines and parameters around the rules going into it. And it also provides a level of accountability and reassurance to your church that this is a very well thought out process. Also, there needs to be a stated time frame. When do we plan to utilize this money? All of this money should have a due date attached to it. Is this for 5 years from now? 10 years from now? Is this a situation where some of this money we can utilize in 2 years, but the bulk of it is going to be later on? It's not to say that if you say our time frame is 5 years, and 5 years we then must use all of that money, but rather best we know sitting here right now what is our expected time frame, and that may change in the future, but we need to give ourselves a good time frame to work off of, because this is going to determine the appropriate risk level. That's a really, really important part of that equation. And it doesn't have to be a question necessarily of deploy money now or hoard for later. You can actually do both in some cases. So for instance, somebody gives a significant one-time gift, maybe $1 million to the church. You say, okay, and they designate it for supporting missions. So you might say, hey, we're gonna take some of that money right now and support some one-time needs, and then we're going to take another portion of it and we're going to invest it, and we're going to distribute 5% of the account value every year, and we're going to support these 10 missionaries or mission agencies each year with this amount of money, and then we're going to invest the balance for future years, so that way this gift can independently and consistently support missions for many, many years to come. If the church is concerned or wants to be extra cautious about investing in any stocks that go into companies that the church members might find objectionable, there are biblically responsible investing funds that help to screen out those types of companies, so that might be an appropriate thing for churches to use. And then last thing on this point is utilizing a donor advised fund can be a really powerful way for a win-win for the church and for the membership. Sometimes the churches with your biggest givers, and this almost inevitably happens, that a significant portion of the church's budget comes from the top 20% of givers, people that have the biggest capacity to give. And very often their assets are in things that have appreciated in value, like stocks or mutual funds. And the problem becomes, if they sell those investments, Uncle Sam's going to take a big chunk out of that in the form of capital gains tax. But the church can set up a donor advised fund, and members can then donate those investments directly into the donor advised fund, receive a charitable deduction for that amount, but then the church can sell those investments inside their donor advised fund instead. When the church sells it, there is 0% owed in taxes. So a great win-win. The church is able to receive a sizable contribution, but the member is not only able to help the church in a big way, but also able to save a lot in taxes in that process. So let me leave you with this. I say, Nate, okay, a lot of good thoughts, a lot of good principles to consider, but what would that even look like? Let me just give you 4 examples, 4 levels of risk, of 4 potential ways that a church might structure their investments. I'm going to start with least risky and move up from there. These are not all the options, obviously, but hopefully this gives you an idea of the possibilities depending on the church situation. So in option number 1, the church wants to be as safe and least risky as possible. Well, that's where you're going to use the money market or a savings account. You know what the account's going to do. The return is just going to be based on the interest rates, but it's always going to be positive. You're always going to get something. And it's just going to be close to whatever interest rates are currently at. So right now it's 3 or 4%, but it could be lower in the future. It could be higher. There's very little risk because as long as the bank is solvent, you're going to get your interest and it's not going to drop like the stock market can. You can also dip into your money. You can access it at any time, penalty free. But the downside is that the returns are usually going to be on the low end comparatively, and you're probably going to get the least amount for your money in the long run. Second approach would be laddered CDs. Many churches do this instead. What they do is they take those reserve funds and they divide it into, let's say, 5 portions: 1, 2, 3, 4, and 5 year certificates of deposit, and and even amount each, so $200,000 each. And by this way, what you could do is, you could do this with bonds, by the way, too. It doesn't have to be certificates of deposit, depending on what interest rates are being offered. Maybe bonds might be paying a little bit more, so you might want to do it with bonds. But either way, whenever the 1 year comes due, then you would take that money, the $200,000 plus the interest it accumulated, and then you would buy another 5 year. So in that way, and you do this each year, so that each year there is a bond that is coming due. And then if you need to utilize some of that money, you can go ahead and utilize it. And if not, if you have extra money, you can roll that into the new 5 year CD. The money is still very safe. You can probably get a higher return structuring it this way because you're taking the risk out of interest rates going up and down. You're locking in a new interest rate every single time. The one downside was that, if you do have to access that money while the CD is still in progress before it's matured, there would be probably a penalty to access it early. But you still can't lose the money with a CD if the bank itself, you can't lose unless the bank itself goes under with the CD, and even then there would be FDIC insurance. Third option would be maybe a little bit of a combination. You say, okay, I like the idea of a laddered CD, but I want to make sure that some of the money would have a little bit more growth potential, but I would also be concerned about market risk. I wouldn't want to take too much risk and maybe put all that in the stock market itself in case the stock market has a bad year or a bad few years. Well, there's something called a buffer ETF. Buffer ETFs. ETFs are like mutual funds, and the way you could do this is combine laddered CDs with buffered ETF. So maybe 60% goes into a laddered CD. So you take 60% and you do the 1, 2, 3, 4, 5 year bonds. And then you take 40% and you put it into one of these buffer ETFs. And the way that works is it tracks the market, and it has a cap for the downside and a cap for the upside. So for example, let's say the buffer ETF might have a cap of 8% and it has 100% protection. That means if the market is down for the year, no matter how much, you are protected. That principal amount is protected. So if the market is down 1% or 80%, you don't lose anything. But if the market is positive, you would get the same return as the market, but it would be capped at 8%. So if the market had 3 years of 15, 22, and then 30%, you would get 8% for each year because that's the cap. But if the market was down 15%, then up 6%, then down 3%, well, you would get 0, 6, and 0 accordingly because you always get what the market gets. And if the market is down, you just get 0. And what that would do is give you the potential for higher gains on the buffer ETF side. But you'd also not have to risk that principal amount. So the downside is that if you get a poor 5 to 7 year run in the market, maybe what you got through that buffer ETF would not have been as good as what you could have gotten through CDs. So, but it allows you to be a little bit more growth oriented or take a little bit more of a chance for a higher return with a portion of that portfolio. And then the fourth option would be something what we call like an all-weather or all-seasons portfolio. And the way this would work is it's a very diversified portfolio that's designed to be very low risk and have a moderate return. So very different than how most people might invest in their 401k or Roth IRA, which would be more growth or more aggressive oriented. What it does is it invests across multiple different investment types, maybe a little bit in stocks, a lot in high quality bonds, maybe a little bit in gold or commodities. But by spreading the money out among many different types of investments that move independently from each other, you're able to put together a portfolio that doesn't swing up and down nearly as much as other portfolios would, but it also has a long-term track record of more modest returns, more in the neighborhood of 5, 6, 7, 8% over 15 to 20 year time periods. Now, of course, the upside would be there's a potential for a higher return, but the downside would be that there are going to be market swings. It's going to cause it to fluctuate, and there's going to be some years where it's down. I know that was a lot to take in, but if this is a question that you've wrestled with for your church and you have questions about investing, or maybe it's just a nonprofit, not even a church, and you would like to talk more, you can always schedule a call with me, my website, nateskelly.com, or shoot me an email, info@nateskelly.com, and be happy to talk more with you. If you have other thoughts or maybe some other things that I didn't talk about, arguments in favor or against, I'd love to hear those as well. You can shoot me an email with that. Thanks as always for listening and watching, and I'll see you on the next episode.